So there's a lot of financial products out there right now, and if you get them wrong, you can have huge fines. So in this video, I'm going to be breaking down what the differences are between a residential and a buy-to-let mortgage and how you can get the right one. The first thing to think about is the purpose of the loan. With a residential mortgage, what you're looking for is to purchase a house to live in. Now, this has to be what is known as a C3 dwelling. So a house, a flat, whatever it is for you to live in personally. And a buy-to-let mortgage is specifically for a residential property. Again, a house, a flat, not an office, not industrial, not a retail unit, for somebody else to live in on a buy-to-let basis. Now, the question that comes up is, can you use a residential for a buy-to-let? Yes and no. Okay, no, you cannot do that if you are buying it for the purpose of renting it out. That's actually committing mortgage fraud. And a lot of this fraud is based around your intent in the first place. What you can do, however, is you can get something called consent to let. Now, it's actually a lot easier than you think. In general, you get in touch with your mortgage company, you say, hey, I've not managed to sell my property yet. I'm going to rent it out for a year. Can I get consent to let on this mortgage? Often what happens is they give you 1 year at a time. Sometimes they'll ask you to add in a bit of money for the equity, but in most situations they just go yes and then get in touch in a year and do the same. However, you cannot have the intent in the first place. So say you're in a situation where I own my property, I don't want to sell it, I want to keep it, I'm going to buy another residential, which you can do 2 of in the UK, by the way, and then I'm going to rent out my current property once I buy the other one. I'll get consent to let on it and roll on in. Next is payment types. Now, this is only a slight difference, but it is important for your investment portfolio versus your residential. Your residential property, the one you're living in, almost all of the mortgages, they are repayment mortgages. And the whole idea of this is at the end of your mortgage term, say you get a 30-year mortgage, it's paid off. You officially own the property outright. And this is a big drive by the government and people lending money, is that they want people to have this almost as their pension responsibility. And the government's really pushing that because pensions just aren't enough to pay people anymore. And another video, just a broken system. On the investment side, it's almost the complete opposite. Now, what they're relying on is getting you to borrow more and more and more and more. It's good for the economy, it's good for the bank, and it's actually good for you in terms of leverage. So you usually will have an interest-only mortgage on your properties. And the reason for this is as property values go up over time, you're able to refinance, pull out more money by borrowing more money to build your portfolio, so on and so forth. What's important there is it maximizes your income, your cash flow, whilst you own the property because you're not paying down the mortgage. But what it also does is increase your risk, because a lot of people get to the end of their 20-year term, for example, not really realizing it's interest only and the implications. But what that means is all you've done over 20 years is pay interest. So let's say you borrow £100,000 and you pay interest for 20 years. At the end, you still owe £100,000. The next thing is LTV, loan to value. It's actually a real misconception, loan to value. Every bank calls it loan to value. Really, I think it should be called loan to purchase. What loan to value means is, let's say the property is worth 100,000 and they give you a 75% loan to value, then what they're giving you is £75,000, 75% of 100. However, what they really mean is loan to purchase. So let's say the property is still worth 100,000, but you buy it at 80,000. For some reason, you've managed to get a 20 grand discount, which does happen from time to time. You'd think, well, they're still going to give you 75,000, right? Because it's worth 100. No. The bank will find out what you're paying for it. The valuer will almost always just go, yeah, they're good for 80 grand, and they'll give you 75% of the purchase price. So that's the first thing to note. But really, how do they differ? A residential property, typically, you will need to put in a 10% deposit. So you get a 90% loan to value. Now, actually, the government's given a lot of stimulus to banks to increase the lending out there so you can borrow more, helps people younger getting on the property market. So you will find some 5% deposits where you're getting 95% loan to value. And then in general, the more money you're borrowing past that 10%, the more interest you're going to pay. And the lower that loan to value, say 80%, the less interest you're going to pay. On a buy-to-let, it's slightly different. Well, it's actually very different. You get typically a 75% loan to value. So residential £100,000 house, you need 10 grand deposit. On a buy-to-let £100,000 house, you need to put in 25,000. Seems unfair, right? Well, not really. First of all, you're an investor. Grow up, you poor thing needing to put in more money to make more money on your money. It's ridiculous, right? But also it's increased risk. You have to think of it from the lender's point of view. If it's your house, you're taking responsibility, you're borrowing the money, and you decide not to pay it, well, you can jog on and I'll take the house back, thank you very much. But in this situation, it's not you that it actually only impacts. For a bank, what they're going to have to do if they need to take it, you just go, do you know what, I'm just not going to pay your bank, which does happen, believe it or not. People just go, nah, screw that, I'll just give back the keys. But from the bank's point of view, what they need to do is either sell it with the tenant in, which naturally will appeal to less people because the open market isn't going to buy. If you want to buy a house to live in, you're not going to buy one with a tenant in, right? So it reduces it to investors only. And what do investors want? A great price. So they either need to sell it for lower than it's worth to get it done quickly because it's all about speed, or they actually need to evict a tenant, which is really shit, isn't it? If a tenant's been paying you and then you've been a knob and decided not to pay the bank, sometimes they'll even evict a tenant and get them out so they've got a vacant possession property. Banks, is that a risk? No, not as much, but the tenant could trash it in response, which does happen. But banks, especially because of the financial crisis, they really care a lot more about their brand nowadays. They didn't really before because, you know, archaic system. But now they do look at the corporate social responsibility, how they can be seen as friendly, and, you know, putting a tenant on the street kind of doesn't get seen as a big deal. What a shock, right? So you do have a different loan to value and you need to factor it in with your purchases. Finally, I like to look at why would they lend you money and how do they work it out? Well, this is very different, and I mean very different. When you're purchasing a property to live in, a residential property, they are basing it on what you are earning. It's called a multiplier. Often, if you are the sole person buying, they will usually get your net salary and times that by roughly 4.5, between 4 and 5, dependent on the lender. If you're buying with a partner or a friend or whatever, and they're going to take account of that second person's mortgage, I'm not actually sure the reason why, if I'm honest, but the second person isn't 4.5. It's more like 2 times their salary. So a much smaller portion of what they're earning. But it's based on what you are earning overall as an income, because obviously that's what the risk is on. On a buy-to-let mortgage, it works slightly differently. So you often do need a salary, and really that salary to start investing is around 25,000. Can you get a mortgage with less than 25 grand? Yes. And once you own property and you're an experienced landlord, which own a buy-to-let for a year, you're an experienced landlord. You're not, but they call you that, right? Because they're idiots. But anyway, you don't even need a job then, because once you're an experienced landlord, you've proven yourself, right? You're a property magnate. Now you've got one tenant paying you. You get my sarcasm. So 25 grand, it gets you on the ladder. And then everything else is by coverage. What is coverage? Coverage is the amount that the rent covers the mortgage. Right now, you're usually looking at 130%. So let me just give you an example. Let's say you're borrowing £100,000 at 5%. That means per year, you're paying £5,000, okay? 5% of 100,000, £5,000. And if they want 130% coverage, you're gonna times that number by 1.3. So £5,000, 130% or times 1.3 is 6,500. So what they're gonna be looking at is that rent, which is, I don't know, 566, whatever it is, but a yearly rent of 6,500 as a minimum. And as long as you've got a good credit history, you've got a salary that hits that threshold and coverage is 6,500, they will lend you the money. Why would they take that additional risk? Because they're relying on a tenant paying you rent, making sure you're making your profit margin and getting to pay them as well. Now, why is that so good? Well, it means you can buy again and again and again and again and again. So there is no limit whatsoever with buying buy-to-let properties, whereas in the UK, you can only get 2 residential mortgages at once. A lot of people think it's 1, but think about it logically. If you're moving to your next house, you can't rely on selling this property before buying the next, right? So you can actually get 2 mortgages as a residential and unlimited amounts in a buy-to-let. So my question to you is, have you had a residential? Have you had a buy-to-let? And some of you might have had both. Let me know your experience. What restrictions did you come up against? And what else did you come up against that I didn't mention in today's video? Leave a comment below. I'll reply to as many as possible. And hey, whilst you're here, make sure to hit the like button. And if you're new to the channel, subscribe to it, hit the notification bell, and I'll see you in the next video.